Vale, ya, cuando quieras.
Here we go. So let's pick up where we left off. Let me find where I left off. Here. Okay. Gold can act as a safe haven. Whether it is the tensions in the Middle East, Africa, or elsewhere, it's becoming increasingly obvious that political and economic uncertainty is another reality of our modern economic environment. For this reason, investors typically look at gold as a safe haven during times of political and economic uncertainty. Why is this? Well, history is full of collapsing empires, political coups, and the collapse of currencies. During such times, investors who held gold were able to successfully protect their wealth, and in some cases, they were even able to use the commodity to escape from all the turmoil. Consequently, whenever there are news events that hint at some type of global economic uncertainty, investors will often rush and buy gold as a safe haven, as a protection. Gold can also diversify your investments. In general, gold is seen as a perfect diversifying tool. It is clear that gold has historically served as an investment that can add a diversifying component to your portfolio, regardless of whether you're worried about inflation, the decline of the US dollar, or even just protecting your wealth. It's always good. And if your focus is simply diversification, gold is not correlated to stocks, bonds, or real estate. It's just gold. It's just this shiny rock. Now let's look at gold as a dividend-paying asset, an asset that pays dividends. Gold stocks are typically more appealing to growth investors than to income investors. So ambitious and risk-prone investors. Gold stocks generally rise and fall with the price of gold, but there are some well-managed mining companies that are profitable even when the price of gold is down. Increases in the price of gold are often magnified in gold stock prices. So if the price of gold rises, the price of gold stocks rises even more because people are interested in it and everybody invests in it and it just mushrooms. So a relatively small increase in the price of gold can lead to significant gains in the best gold stocks. And typically owners of gold stocks obtain a much higher return on investment than owners of physical gold. Even those investors focused primarily on growth rather than steady income, as I was saying before, even they can benefit from choosing gold stocks that demonstrate strong dividend performance. Stocks that pay dividends tend to show higher gains when the sector is rising, when the sector is successful. And usually they're also better than non-dividend paying stocks when the overall sector is in the downturn. So it's always better. Now let's look at the gold mining sector, the concrete extraction of gold. The mining sector, which includes companies that extract gold, can experience high volatility. So when evaluating the dividend performance of a gold stock, you must consider the company's performance over time in regard to dividends. Factors such as the company's history of paying dividends and the sustainability of its dividend payout ratio are two key elements to examine in the company's balance sheet and in the company's other financial statements. So basically, in layman's terms, what does this mean? You have to look at if your company's even paying out dividends, or are they paying back their shareholders and their investors? And if they're doing it, are they doing it responsibly and in a way that can be sustainable over the long term? It's no use getting 1 million this month and then having no dividends for the next 10 years. Your company has to have good planning. So a company's ability to sustain healthy dividend payouts, as I was saying, is greatly enhanced if it has consistently low debt, so low debt levels and strong cash flows. Every company goes through growth and expansion cycles when it takes on more debt. And sometimes it has lower cash on hand. Yeah, it can happen. So it's imperative to analyze their long-term figures. How do they fare over the years and over the decades? You can't just look at a short financial performance. So what are the different ways of owning gold? One of the main differences between investing in gold several hundred years ago and investing in gold now is that there are many more investment options. You have gold futures, gold coins, gold companies, gold ETFs, exchange traded funds, gold mutual funds, gold bullions, and gold jewelry. Is it a bad time to invest in gold right now? Well, in order to ascertain the investment merits of gold, let's check its performance against that of the S&P 500 for the past 10 years. Let's compare those two. So gold has underperformed compared to the S&P 500 in the 10-year period between 2008 and 2018. Okay, because the GSCI index, the gold index, generated 3.27% compared to the S&P 500, which has returned 10.36% over the same period. So gold grew 3% and the S&P 500, the stock exchange, grew 10%. However, gold trounced the S&P 500 in the 10-year period before that. So from November 2002 to October 2012, so not exactly before, there's an overlap there, but between 2002 and 2012, gold was much more performant. There was a total price appreciation of gold of 441.5%. I'll repeat that, 441%. So 18.4 annually, 18.4 every year. However, the S&P 500, on the other hand, appreciated by 58% over those 10 years. So 400% versus 58%. The point here, with all those numbers, what's the point? Gold isn't always a good investment. Nothing is always a good investment. The best time to invest in almost any asset is when there's a negative sentiment, when there's concern, panic, and when the asset is inexpensive. That provides substantial upside potential, so increasing potential. For example, now is a good time. We're going through a crisis right now. That's when you have to invest. You buy low, you buy when nobody else wants to buy and prices are low because everybody's panicking, everybody's hoarding, and then you sell high. That's investment 101. You have to buy and be active in a crisis. In a nutshell, it's always profitable to invest during a crisis. And that advice holds true for any investment and practically any crisis. Again, the best example is now. So bottom line, there are both advantages and disadvantages to every investment. If you're opposed to holding physical gold, then maybe you want to buy share in a mining company. That's a safer alternative for you. If you believe gold could be a safe bet against inflation, then you ought to invest in coins, bullions, or jewelry. And lastly, if your primary interest is in using leverage to profit from rising gold prices, then the futures market might be your answer, sorry. But note that there's a fair amount of risk associated with futures markets and leverage-based holdings. So basically, wild speculation, that's what I mean. Wild speculation, as the name suggests, is very risky. So dear friends, don't worry if you didn't understand everything. I myself had a hard time wrapping my head around some of the financial concepts when I prepared the speech. As a matter of fact, I'd like to recommend the book Homo Deus. I will link it in the description. Homo Deus, A Brief History of Tomorrow. That's the whole title. The author, Yuval Noah Harari, explains that the world has become far too complex for one single human being to understand it fully. And it's quite comforting. I find solace in his opinion, especially when I'm at a loss, trying to understand astrophysics or nutrition or international finance. It's too complicated for us to understand everything. That's very comforting to me. I also recommend Homo Sapiens, A Brief History of Mankind, of Humankind, and a third book, 21 Lessons for the 21st Century. They're all by the same author, Yuval Noah Harari. Sorry. Thank you for listening and have a great day.